Hello and welcome. This is the first video in an 8-part series I call Beginner Foundation Volume Profile Series. Even if you are very familiar with the volume profile, I still strongly encourage you to watch the entire series, as you will most likely learn a few new smart money secrets along the way. Alright, let's get started. This video is titled, What is Volume Profile? Beginner's Guide to VAH, VAL, and POC. Most traders look at a chart and see candles. Professionals look at a chart and ask a different question. They ask, where did business actually get done? That is the point of the volume profile. If you trade futures and you do not understand value or value migration, you are going to keep taking trades in the wrong places. You will chase breakouts straight into resistance, fade moves in strong acceptance, and get chopped up in the middle of the auction without understanding why. In this video, I'm going to give you a beginner-friendly framework for volume profile, and specifically 3 terms you need to understand first: VAH, VAL, and POC, because once you understand those 3, the market starts to look very different. Make sure you watch all the way through for a special volume trading tip at the end. Okay, so here's the problem. Most beginner traders learn patterns before they learn context. They learn candles, they learn indicators, and they learn random entries. But the market is not moving because a candlestick pattern on your screen. The market is an auction. Price moves higher and lower to facilitate trade, discover value, and test where participants are willing to do business. That is why 2 identical looking candles can mean completely different things depending on where they form relative to value. And that is exactly where the volume profile becomes useful. What does the volume profile actually do, or what is it? Volume profile is a tool that shows you how much volume traded at each price level over a selected period of time. Not how much volume traded in a candle, but how much volume traded at a specific price level. That distinction matters. A normal volume bar at the bottom of your chart tells you how active a time period was. Volume profile tells you where the market spent the most business. That gives you a map of the auction. It helps you identify where the market considered price fair, where it considered price too cheap, and where it considered price too expensive. And if you are serious about execution, that matters far more than memorizing chart patterns. Okay, this is the core idea. Value. Now, before we define VAH, VAL, and POC, you need one idea locked in. The market constantly rotates around value until value migrates. That is one of the core principles behind trading on the edge. And when the market is balanced, price tends to rotate around a fair value area. When the market becomes imbalanced, price can leave that area and discover a new one. So volume profile is really helping you answer one simple question. Where is value right now? And once you know where value is, you can make a much better decision about location, risk, and target selection. What is POC? So let's start with the easiest one. POC means point of control. The POC is the price level where the most volume traded during the profile period you are measuring. That makes it the price of the greatest agreement. The price where the most business was done, the price the auction kept returning to. Think of it as the center of gravity for that auction. And if the market is balanced, the POC often acts like a magnet. Price may move away from it temporarily, but the auction is still balanced and it can get pulled back to that area. Now, that does not mean you blindly buy or sell the POC. That is a retail rookie mistake. The POC is not a signal by itself. It is merely context. It tells you where the market has done the most business. It tells you where the participation was strongest. It tells you where the market may perceive fair value. And that matters because trades initiated near fair value are often lower quality unless you have a very specific reason and confirmation. Mid-range trades are often where traders get chopped up. What is VAH? Well, VAH means value area high. The value area high is the range where roughly 70% of the volume traded during the profile period took place. VAH is the upper edge of that value area. In plain English, it is the high boundary of what the market considered fair during the session or profile period. When price reaches VAH, the market is testing the upper extreme of value. That is important because extremes are often where better decisions tend to happen. At VAH, one of two things usually matter most. Is the market rejecting higher prices and rotating back into value towards the VWAP or POC? Or is it accepting above value and preparing to migrate value higher? That is the real question. Not, should I short VAH because it is resistance? That is far too simplistic. Professionals are not just looking at the level, they are looking at the behavior at the level. What is VAL? VAL means value area low. This is the lower edge of the value area. It marks the lower boundary of where the market considered price fair during the selected profile period. If VAH is the upper edge of value, VAL is the lower edge of value. So when price trades into a VAL, the market is testing the lower extreme of value. Again, the important question is not just whether price touched VAL. The important question is what happens there. Does price probe below value and get rejected? Did buyers defend the lower extreme and rotate price back towards fair value? Or did the market accept below value and begin discovering lower prices? This is where the auction framework starts to become practical. At the edge of value, you are often dealing with asymmetry. Because invalidation can be cleaner, and the market is showing you whether that extreme is being accepted or rejected. That is much better than forcing trades in the middle of the range. How VAH, VAL, and POC work together. Now let's put the three together. POC is the center of gravity. VAH is the upper edge of value. VAL is the lower edge of value. So together they define the auction's edges. They show you where the market spent the most time doing business and where the boundaries of fairness were for that session or profile period. This gives you a framework for thinking in terms of location. Above VAH, the market is outside the upper edge of value. Below VAL, the market is outside the lower edge. Near the POC, the market is near the area of greatest agreement. This changes how you think about the trade quality. Trades from the edges back toward the center can make sense in imbalanced conditions if rejection is confirmed. Trades above or below value can make sense if the market shows acceptance and value migration. Trades in the middle without a strong reason are often low quality and low asymmetry. That is why structure matters more than trade ideas. What beginners usually get wrong? The first mistake is treating VAH and VAL like automatic support and resistance. They are not magic lines. They are references inside an auction framework. The level matters, but the response matters more. The second mistake is ignoring market condition. In balance, value area references often behave differently than they do in trend. In balance, rotation is more likely. In imbalance, continuation is more likely. You need context. The third mistake is trading in the middle of value. This is where a lot of new traders lose money. They get an idea, they enter near the POC or mid-value, and they have no structural edge. There is no meaningful asymmetry there. No clear invalidation, no strong target logic, just noise. The fourth mistake is using volume profile as a standalone signal. It is not. It becomes much more powerful when paired with confirmation. That can include tempo, response at the level, order flow, delta, acceptance, rejection, or how price behaves around the prior session structure. I like to use large volume study on Sierra chart in addition to the volume profile. What professionals look for instead. Professionals use volume profile to frame decisions, not to replace thinking. They want to know, where is value? Is price inside value, above value, or below value? Is the market accepting a move away from value or rejecting it? Is this a balanced auction or an imbalanced one? Where is invalidation logically located? Where is the target magnet? That is the key difference. They're not asking, where can I force a trade? They are asking, where is the structural asymmetry? That is where the better trade starts. Not with prediction, but with location and confirmation. How this affects entry, invalidation, and targets. Now this is where volume profile becomes actionable. For entries, the best opportunities often come at meaningful structural locations, especially around the edges of value, not in the middle. For invalidation, the structure should tell you when your idea is wrong. If you are trading rejection from above VAH, the market should not continue accepting above value. If it does, your thesis is likely wrong. That is structural invalidation. For targets, volume profile gives you logical magnets. If the market rejects an upper extreme, POC can become a natural target. If it continues rotating, VAL may become the next target. If the market accepts above VAH and starts building a new area of trade, then the old value area may matter less, and the market may begin discovering a new fair zone. This is why trade location matters more than your trade idea. A mediocre idea from a great location can often outperform a great idea from a terrible location. Where to start as a beginner? If you are new to volume profile, do not overcomplicate this. Start with 3 questions every day. Where is POC? Where is VAH? Where is VAL? Then ask, is the market trading inside value, outside value, or attempting to move value? And finally, at the extremes, is the market showing acceptance or rejection? That alone will improve how you read NQ and ES. It will slow you down, but in a good way. It will stop you from chasing low-quality entries, and it will help you focus on where the auction actually matters. This is also one of the reasons I wrote Trading on the Edge. The goal of the book is to give serious futures traders a complete operating framework for reading value, structure, confirmation, and execution without paying for an overpriced course. The free content of this channel teaches you the concepts, but the book connects them to the model, so you can actually apply them with more consistency. So if this idea is of value to you, acceptance versus rejection, and structural trade location is clicking for you, the book will help you go much, much deeper. So to simplify everything, volume profile shows you where volume traded at price. POC is the price where the most volume traded. VAH is the upper edge of value. VAL is the lower edge of value. And together they will help you identify where the market considered price fair, where it is testing an extreme, and whether that extreme is being accepted or rejected. That is powerful because the best setups usually do not come from random entries in the middle. They come from meaningful structural locations with clear invalidation and logical target magnets. That is how professionals think about auction. And that is a much stronger foundation than simply guessing direction. Okay, for those that stayed, here's the bonus tip. I wish I knew this professional secret when I first started trading. So this is how some of the most profitable future traders catch some monster trades on NQ. Watch this video next to learn the full strategy. The video is titled, How Professionals Catch Big NQ Moves. Alright, so if this video helped you in any way, make sure you hit the like button and subscribe. It's totally free and it will help motivate me to continue making value-packed videos like this one. And if you want the complete framework behind the channel, Trading on the Edge was built to help serious traders turn these concepts into an actual operating model they can journal, review, and execute with. It's available on Amazon.com. All right, thanks. I'll see you in the next one. Take care.